Japan has just sounded a global debt alarm, shaking the foundations of its colossal $12 trillion bond market. The sudden spike in yields and mounting fiscal pressures have sent ripples across international financial systems, leaving investors and analysts scrambling for answers. Is this the beginning of a new era of volatility, or merely a temporary tremor in the world's third-largest economy? As markets react with unease, the stakes have never been higher. Who will bear the brunt of these seismic shifts? Global institutions, everyday investors, or the Japanese government itself? In the face of such uncertainty, one critical question emerges. Should investors brace for impact or seize the moment? The answers could redefine strategies and fortunes on a worldwide scale. For years, Japan's towering national debt was regarded as a curious exception, seemingly immune to the risks that haunt other economies. Experts and investors alike wondered, could a country really sustain such a level of borrowing without consequence? But recent shifts in leadership and a bold wave of government spending have shattered that sense of security. Is Japan's financial resilience finally reaching its limits, or will it once again defy the odds? As the world watches, the stakes have never been higher. Who will be proven right in this unfolding economic drama? Prime Minister Senate Takaichi's unexpected announcement of a $135 billion stimulus package has sent shockwaves through financial markets. Investors are scrambling to understand the scope and intent behind this massive injection of capital. Politically, the move appears calculated to address mounting economic pressures and bolster public confidence ahead of key legislative sessions. The sheer size of the package raises questions. Is this a genuine effort to stabilize the economy or a strategic play to sway voter sentiment? In the immediate aftermath, markets have responded with heightened volatility as traders reassess risk and opportunity. Some see the stimulus as a lifeline, while others worry about long-term fiscal consequences. The coming days will reveal whether this bold maneuver can restore stability or simply fuel further uncertainty. Japanese government bond yields have surged to heights unseen since 1997, sending shockwaves through financial markets. For decades, Japan has relied on ultra-low interest rates to sustain its massive public debt and support economic growth. But now, even a modest uptick in yields can dramatically increase the government's borrowing costs, putting immense pressure on the national budget. What does this sudden spike mean for the stability of Japan's financial system? Is the era of cheap money coming to an end? And if so, who will bear the brunt of these changes? The stakes are high, and every move in the bond market could have far-reaching consequences for investors and policymakers alike. Japan now stands on the edge of a financial precipice, with economists sounding alarms that echo the chaos seen during the UK's Liz Truss crisis. The nation's debt service costs are climbing relentlessly, squeezing the government's ability to maneuver. Persistent warnings from experts paint a picture of a looming fiscal reckoning, one that could erupt if policymakers refuse to alter their current trajectory. Is Japan truly at risk of a meltdown, or are these fears overblown? Who bears responsibility for steering the country away from disaster? As the pressure mounts, the world watches closely. Will Japan act in time, or is a crisis inevitable? Imagine a scenario where market confidence in Japan evaporates overnight. The immediate result could be a rapid, widespread sell-off across Japanese bonds, equities, and the yen itself. But the shockwaves wouldn't stop at Japan's borders. Global investors, already wary of volatility, might rush to unwind positions in other markets, amplifying the turmoil. Could this trigger a domino effect, destabilizing financial systems from Europe to the United States? The interconnected nature of today's markets means that a crisis in one major economy can quickly ripple across continents. Are international safeguards robust enough to contain such contagion, or would we witness a new chapter of global financial instability? Japan stands as the single largest foreign holder of U.S. government debt, making its financial health a matter of critical importance for Washington. What happens if Japan faces economic turmoil or decides to reduce its purchases? The consequences could ripple directly into American markets, potentially driving up borrowing costs and shaking investor confidence. Is it wise for the United States to rely so heavily on one nation to fund its fiscal needs? This dependence turns the relationship into a high-stakes gamble, where instability on one side could trigger a cascade of challenges on the other. In a world where global finance is tightly interwoven, are both countries prepared for the risks they share? Under Takaichi's policies, the Japanese yen has hovered near its weakest point in 50 years, a dramatic shift for a currency once considered a global safe haven. What has caused this transformation, and why do investors now view the yen with such caution? Instead of providing stability during turbulent times, the yen now behaves more like the currency of an emerging market, prone to sharp swings and increased vulnerability. This raises unsettling questions. Can Japan regain the trust of international markets, or has the yen's reputation been permanently damaged? The answers remain uncertain, fueling anxiety among both domestic and foreign investors. For years, the Japanese yen was seen as a safe haven, strengthening whenever global uncertainty struck. But today, that narrative is shifting dramatically. What happens if confidence in Japan's financial stability falters? Instead of capital flowing in, we could witness a rapid exodus, driving the yen even lower. This reversal doesn't just impact Japan, it could send shockwaves through global markets, intensifying volatility and risk. Are we witnessing the end of an era for the yen, and what does this mean for investors worldwide? In a dramatic shift, the new administration has scrapped Japan's long-standing goal of achieving a primary budget surplus. Instead, they have unleashed a wave of government spending, blending ambitious industrial policies with populist measures aimed at winning public support. This approach has sparked heated debate. Will these investments truly drive sustainable growth, or are they simply fueling short-term optimism? Critics argue that a significant portion of the spending lacks strategic focus and risks being squandered. As fiscal discipline takes a back seat, questions arise about the long-term consequences for Japan's economy and its financial stability. Is this bold strategy a necessary gamble or a costly misstep? Japan finds itself at a critical crossroads. After years of ultra-low interest rates, inflation has surged back, abruptly ending the era of cheap, zero-rate financing that once kept the country's massive debt under control. Now, as older government bonds mature, they must be replaced with new debt at much higher yields. This shift means Japan's interest expenses are poised to climb sharply, putting additional strain on public finances. The timing couldn't be worse, raising urgent questions about how policymakers will respond and whether the nation can adapt to this new reality. Is Japan prepared for the financial shock that looms ahead, or will rising costs trigger broader economic consequences? According to the International Monetary Fund, Japan's interest payments are projected to double by 2030 and could quadruple by 2036, even if market conditions remain stable. But how often do major financial shifts unfold in a calm and predictable manner? History suggests that regime changes are rarely orderly, and when turbulence strikes, governments may resort to extreme solutions. Could Japan be forced to impose wealth taxes or even freeze bank deposits to manage its soaring debt? The prospect is unsettling, raising urgent questions about the safety of assets and the limits of policy intervention. In this environment, is anyone truly prepared for the consequences if stability gives way to crisis? Japan stands at a critical crossroads, grappling with profound structural issues that threaten its economic stability. The nation's population is shrinking, while economic growth remains persistently sluggish. At the same time, the costs associated with an aging society are steadily rising, placing additional strain on public finances. These challenges are not temporary. They reflect deep-rooted trends that could undermine Japan's future prosperity. Without credible and decisive fiscal reforms, the country's debt dynamics are likely to deteriorate even further. The question remains, can Japan break free from this cycle, or will these pressures push its economy into even more precarious territory? Japan's current financial struggles are not isolated. They reflect a growing global phenomenon. Across the world's largest economies, a dangerous intersection is emerging. Soaring national debts are now meeting the reality of higher interest rates. The United States, China, and Europe are all grappling with unprecedented debt levels, and the cost to service these obligations is climbing fast. What happens when governments can no longer ignore the mounting interest payments? Are we witnessing the early signs of a worldwide financial reckoning, or is this just another cycle in the relentless march of global markets? The stakes are enormous, and the answers remain uncertain. Central banks around the world have maintained high interest rates in an effort to keep inflation under control. However, this strategy comes with significant consequences. Governments now face rising costs just to service their existing debt, diverting resources away from critical areas. As a result, less funding is available for investment in infrastructure, social programs, and economic stimulus initiatives. The impact is particularly severe in developing countries, where budgets are already stretched thin. Does this balancing act between inflation control and fiscal sustainability risk pushing vulnerable economies into deeper hardship? The tension between monetary policy and government spending is becoming increasingly difficult to ignore. Shocking new data from the United Nations reveals a troubling global trend. Billions of people now reside in countries where the cost of servicing debt, just paying interest, has overtaken government spending on essential services like health and education. This isn't just a distant problem. The United States is heading down the same path. In fact, America's annual interest payments have already crossed the staggering threshold of $1 trillion. What does it mean when a nation spends more on debt than on its people's well-being? Who is responsible for this shift, and is there a way out? As the numbers climb, investors and citizens alike are left questioning whether the current trajectory is sustainable, and if now is the right moment to take action, or to hold back. Global debt has soared to an astonishing $337 trillion, shattering all previous records. At the same time, governments are issuing bonds at an unprecedented pace, flooding the market with new debt. But what does this mean for the stability of the financial system? Markets today are more volatile, more fragile, and more tightly interconnected than ever before. Could a single shock in one major economy, say Japan, be enough to send ripples across the globe? Who would bear the brunt, and who would seize the opportunity? As these numbers climb, the line between calculated risk and looming crisis grows ever thinner. Japan's financial system has long been considered resilient, supported by substantial external assets and a central bank with the ability to intervene when necessary. These buffers have helped shield the country from global shocks and maintained investor confidence for decades. Yet, beneath the surface, cracks are beginning to appear. The structural foundations that once set Japan apart are gradually eroding, raising questions about the sustainability of its unique position. Is the era of Japanese financial exceptionalism coming to an end? As these safeguards weaken, the nation faces a pivotal moment that could redefine its role in the global economy. For decades, Japan has served as a stabilizing force in global finance, absorbing shocks and providing liquidity when needed. But as Japan's ability to play this role diminishes, the United States finds itself exposed to new vulnerabilities in funding its government operations. The cushion that once softened market turbulence is thinning, leaving less room for missteps. This tightening margin for error means that even minor disruptions could have outsized consequences. The specter of a debt crisis is no longer a hypothetical scenario. It is edging closer to reality. In this shifting landscape, the question arises: how prepared is the world's largest economy to navigate the risks ahead? Japan stands at the forefront of a potential global debt reckoning, serving as a critical test case for how the world might respond to mounting fiscal pressures. As the nation grapples with unprecedented levels of debt, investors and policymakers worldwide are watching closely, searching for signals that could foreshadow broader economic challenges. Will Japan's strategies offer a blueprint for stability? Or will they expose vulnerabilities that could ripple across international markets? The answers remain uncertain, but one thing is clear: the outcomes here will have far-reaching consequences. In times like these, staying informed is more important than ever. Consider what these developments mean for your own financial security and future decisions.